Welcome to The Explainer. In a world that's so driven by profit, how do we even measure the success of an organization that's driven by purpose? Well, today we're going to unpack the unique financial story of not-for-profit organizations.
Right, let's dive straight into the big question. This is the whole reason accounting for NPOs is so different. For a normal business, profit is the ultimate scorecard, right? Easy. But for an NPO, success is a completely different ballgame. How do they prove to donors, to members, and to the whole community that every single dollar is being used effectively? Really, it's all a question of trust. And the answer? Well, it's hiding in their accounts.
And the world of NPOs is huge. We're talking everything from huge charities and foundations right down to your local sports club. Now, their missions might be totally different, but they all share one critical thing: accountability. Even without a profit motive, they've got to produce financial reports to prove to their stakeholders that they're being responsible with the funds they've been given.
So here's our game plan for today. We'll kick things off with the absolute basics, just the cash facts. Then we'll level up to the full financial story to get a much truer picture. After that, we'll look at a really practical example of accounting for members, and finally, we'll figure out what an NPO's net worth actually is.
Okay, so first up, where does an NPO even start when it comes to tracking its money? Well, with the simplest tool in the shed, the receipt and payment account.
So it's called the receipt and payment account. And honestly, the name says it all. The best way to think about it is just like a summary of the organization's bank statement for the year. It literally just lists all the cash that actually came in and all the cash that actually went out. Pure and simple. Cash in, cash out. And just look at how simple this is. On the left, you've got all the cash coming in, from member subscriptions, fundraisers, you name it. On the right, all the cash going out, for expenses, supplies, whatever. It gives you a super clear picture of the cash flow. But, and this is a big but, does it tell you if the organization was truly successful this year? Not really. It's missing a huge piece of the puzzle. So let's be super clear. This report is just a simple summary of cash. Yeah, it's easy to make, and it shows where the money went. It even includes the big stuff like buying a new piece of equipment. But here's the fatal flaw. It doesn't actually measure the organization's financial performance for the year. And for that, we need a much smarter tool. So, to get that true picture of performance, we've got to move beyond just tracking cash. This brings us to probably the most important financial statement for any NPO, the income and expenditure account. This table shows you the critical upgrade. See how we're shifting from a cash basis to something called an accrual basis? This means we're no longer just tracking cash. We're tracking activity. We account for all income we've earned and all expenses we've used up during the year, even if no money has actually changed hands yet. The end result isn't about cash in the bank. It's a surplus or a deficit, and that is a true measure of performance. Okay, if you remember one thing today, make it this. Accrual accounting is all about one word: matching. You have to match the income you generated from this year's activities against the costs of this year's activities. It's that simple. So income gets counted when it's earned, not just when the cash lands in your account. And an expense gets counted when it's used, not just when you pay the bill.
And you'll notice the language changes here. This is way more than just a name change. It really gets to the soul of an NPO. They don't look for profit. They aim for a surplus, which basically shows they brought in more than they spent. A great sign of smart management. The opposite, of course, is a deficit, which is a red flag that they spent more than they earned in that period.
So how does this whole accrual idea actually work in the real world? Let's take a look at the most common type of income for an NPO: membership subscriptions. Here's a perfect little test. A member pays their 2027 fee a bit early, in December 2026. Does that count as income for 2026? Well, if we're using accrual accounting, the answer is a hard no. Sure, the cash is in the bank, but the NPO hasn't earned that income yet. It won't be earned until it actually provides the membership benefits in 2027. So to get to the true income figure for the year, accountants do a pretty simple calculation. They start with the total cash that came in, then they add any fees that are still owed for this year, and then, this is the important part, they subtract any fees that were paid early for next year. This process filters out all the noise and just leaves you with the actual income earned in this specific period. All right, so we've seen how NPOs track what happens year to year. But what about their long-term financial health? I mean, a regular company has owner's equity. What does an organization with no owners have?
It has something called the accumulated fund. This is the big one. It represents the total net worth of the NPO. You can think of it as the sum of all its surpluses and all its deficits over its entire life. It is the ultimate measure of the organization's financial strength and its ability to keep going.
And the formula to figure this out is beautifully simple. And it's actually the same one used in the for-profit world. You just take everything the organization owns, its assets, and you subtract everything it owes, its liabilities. What's left over? That's the accumulated fund.
In a normal company, this number is called shareholder equity. It's basically the owner's slice of the pie. But in a not-for-profit, the accumulated fund has no owners. It's the financial foundation that belongs entirely to the organization's mission.
And this is where it all comes together. Every single year, the surplus or deficit from that income and expenditure account gets rolled into the accumulated fund. So, a surplus makes the NPO stronger by growing that fund. A deficit, on the other hand, weakens it by shrinking the fund. You can see exactly how day-to-day operations affect the long-term health of the whole organization. Okay, so let's quickly recap what we've covered. NPO accounts tell a story of good management, not profit. The simple receipt and payment account just tracks cash, but it's the more powerful income and expenditure account that reveals the true performance, a surplus or a deficit. And year after year, those results build up the accumulated fund, which is the NPO's ultimate net worth.
Which brings us to our final and maybe most important question. If a charity posts a financial surplus, does that automatically mean it was a successful year? I mean, when an organization's mission is to serve a community, is a healthy bank balance really the best measure of its true impact? That's definitely something to think about.